In 1950, the Republic of Ireland stood in the shadow of its richer neighbour, with average incomes in the UK nearly 3 times greater than Ireland. Yet over the next few decades, the Irish economy was transformed and by the early 2000s had overtaken UK GDP per capita. Since 2015, the gap has soared, with Ireland becoming one of the richest countries in Europe. Why has the Irish economy done so much better than the UK? Is it due to Brexit? Is it due to low tax rates? Or is it just due to dodgy GDP statistics? In 1973, both the UK and Ireland joined the EEC, but it was perhaps Ireland who benefited the most, with regional aid from the European Union boosting investment and infrastructure and helping to transform a small rural economy into a modern global economy. But it was from the mid-1990s that the Irish economy really boomed, helped by low corporation tax rates and a dynamic young workforce. Ireland attracted foreign investment from multinationals such as Intel, Microsoft, Google and later Facebook. Between 2013 and 2021, foreign companies contributed nearly half of Ireland's economic growth. But this foreign direct investment has also distorted Irish GDP statistics. When Microsoft and Google make profit in Ireland, it has limited benefit for Irish citizens, with the profit repatriated back to US shareholders. Excluding output produced by foreign multinationals, gross national income is 24% less. However, even if we compare the UK and Irish economy with an alternative measure, gross national income, Ireland has still done better in recent years. Ireland has attracted many major pharmaceutical companies, and during COVID, they saw record growth in earnings, with exports topping around $45 billion a year and directly employing 50,000 people. And also Ireland benefited from a strong tech sector, which benefited from a boom in remote working that we saw during COVID. By contrast, in recent years, the UK economy has really struggled, and it is no coincidence that since the Brexit vote in 2016, there's been a sharp divergence between the UK and Republic of Ireland. The uncertainties and costs of Brexit have led to falling UK investment, higher costs for trade, and an estimated 4 to 5% loss of GDP had the UK stayed in the EU. Since Brexit, Ireland has increasingly benefited from investment from multinationals seeking an alternative English-speaking entry point into the European Union. However, whilst Dublin has been successful in attracting finance and multinational investment, Brexit has been harder on the agricultural and fishing sector. Observers of the Irish economy do point to a dual economy, a high-tech, capital-intensive sector powered by foreign investment, and a more traditional, jobs-intensive food business. Brexit has reduced fishing quotas, pushing the Irish fishing industry close to despair. And Brexit has also disrupted agricultural trade with the UK. And this has exacerbated the two-speed economy in Ireland, a shining tech sector, but less prosperous in rural areas. If we ignore GDP and GNI statistics, a better guide to actual living standards is just to look at median disposable income. Here the gap is narrower, with Ireland only recently overtaking the UK. But the trend is different. The UK has been stuck with stagnant wage growth for several years, whilst Ireland's trend rate looks more optimistic. But it's not just about income levels that are important. We also need to look at prices. And here Ireland is one of the most expensive countries in the EU, with prices 46% higher than the EU average. And this is particularly acute in essential sectors like food and housing. And also, if we compare actual consumption, recent analysis suggests that the UK has still higher levels of consumption than Ireland. Now, this at least partly reflects the fact that Ireland has a much higher savings rate than the UK. UK households have been squeezed by a cost of living crisis and prolonged stagnation in real wages, and have been more willing to dip into savings. By contrast, Irish households are more willing and able to save for the future. Ireland's saving rate was 14% in 2023, compared to 8% in the UK. But whilst the UK has higher levels of consumption, how long will this last? In 2024, the UK is forecast to enter into recession. Ireland is forecast growth of 4%. High savings also provide something of a buffer for the Irish economy. even if multinational investment was to dry up, the savings would help. One area where there's a surprising degree of affinity between the two economies, Ireland and the UK, is in relation to housing. Both economies have experienced strong population growth, partly caused by migration, but both countries have also failed to build sufficient housing. The result has been a surge in the cost of housing, especially falling on the younger generation. It is one reason why many young Irish people may be sceptical of the very impressive GDP statistics. Ireland's record-breaking rise in GDP has usually not filtered down to the younger generation who struggle to get affordable housing. 68% of the young Irish adults are still living with their parents, the highest rate in the European Union. There's also been a worrying rise in homelessness, as many are locked out of a tight housing market. It has created, a bit like the UK, a two-speed economy between property owners who have benefited from rising prices and the younger generation who pay very high rents. So whilst there's a similarity in the housing crisis, the UK still has significantly higher levels of income inequality than Ireland, 25% worse inequality. And another interesting statistic, in 2020, Ireland's life expectancy from birth was 82 years. 2 years more than the UK. One benefit of the recent surge in Irish economic growth is a record growth in tax revenue. Last year, the Irish government recorded a budget surplus of €10 billion, and this is forecast to grow to €16 billion next year. The UK, by contrast, has experienced rising budget deficits, soaring debt interest payments, and even years of austerity failed to reduce the UK debt to GDP ratio, which continues to rise. In Ireland, at the moment, there's a big debate about what to do with this tax windfall, with young people hoping for more affordable homes, whilst the older generation preferring it to be put towards future pensions. The different priorities point to a split in economic fortunes, but it is a very nice dilemma to have, and a far cry from the 2010 financial crisis and EU IMF bailout. Ireland has really bounced back quite strongly from that crisis. In the current climate, the UK could only dream of a budget surplus, with tax revenues continuing to disappoint, despite a record tax burden on households. What about future prospects? Could the UK emulate Ireland? Well, at the moment, the biggest threat to the Irish economy is an over-reliance on foreign multinational investment for both GDP growth and tax revenues. A large sector of the economy relies on a very low rate of corporation tax. However, the OECD is leading an effort to promote a minimum global corporation tax rate of 15% in a bid to prevent wasteful tax competition between countries. In 2016, Ireland's GDP jumped 26%, purely due to Apple restructuring its company to take advantage of Irish tax rates, a phenomenon Paul Krugman coined as leprechaun economics. But what can come in can also go out. America has toyed with changing tax laws to prevent this loss of tax revenue abroad. And this is something why cutting corporation tax in the UK is unlikely to cause the same level of investment that we saw in Ireland. On a more positive note for Ireland, since Brexit, Ireland has espied new opportunities to offer a more pragmatic alternative to the hard Brexit adopted by the UK. The UK, by contrast, is still reeling from the triple shocks of austerity, low productivity, low confidence and Brexit. Ireland has many problems, and the GDP statistics really do flatter living standards. But it does have more momentum than the UK economy. At the moment, the UK economy is looking in vain for a new spark to overturn all the years of recent poor performance. There was a time when thousands of Irish emigrated to England and America in search of higher wages. But now it's flipped, and it's Ireland which is attracting net migration coming for a booming economy. Although there is reason to be sceptical of GDP statistics, they don't paint the full picture. Ireland still has a lot of potential, if only it could solve its housing crisis. If you found this video interesting, you might also like this one, which goes into more detail on the decline of the UK economy in recent years.